For 25 years, Starbucks defined what coffee meant in the world. When they landed in Beijing in 1999, nobody in the country drank coffee. They built 7,000 stores.
We open a new store in China every day.
And turned a nation of tea drinkers into the second biggest coffee market on earth. Then, in 3 years, the whole empire came undone. Market share went from 42% to 14%. The CEO got fired, and 2 months ago, Starbucks finally threw in the towel on China. They sold 60% of their entire Chinese business and walked away from the market they had spent a quarter of a century building. Behind every one of these blows, the same name keeps coming back: Luckin Coffee, a company most people in the West have never heard of. A company that 5 years ago was left for dead, caught red-handed faking $310 million in sales. They even got kicked off Wall Street for that. Well, today they have 31,000 stores and they're coming back to settle the score. They're actively preparing to relist on the same Nasdaq that threw them out. How does a Chinese fraud, left for dead, come back to bring Starbucks to its knees? And why is nobody asking the real question? What is Luckin actually selling? Because believe me, Luckin's coffee has nothing to do with actual coffee. The real business model is much darker than any coffee Starbucks ever sold. Stories like Luckin don't show up on CNBC because most people writing about Asia have never set foot here. I run businesses in Asia. I've been doing it for 26 years and I see what's happening from the inside. That's why I created this channel. And if that's the perspective you're looking for, hit subscribe. To understand how Luckin came back, you need to understand how brutal the fall was. The company opened its first store in Beijing in October 2017, a small kiosk at the base of an office tower where everything was ordered through a QR code on the wall. 18 months later, they were ringing the opening bell on the Nasdaq, the fastest path from a single shop to a New York IPO any Chinese company has ever pulled off. The stock popped 20% on day one and kept climbing through the year, with analysts at every major Wall Street bank calling Luckin the
Starbucks killer.
And then, in January 2020, an anonymous 89-page report started circulating in the Hong Kong short-selling community. They claimed Luckin had been faking its sales numbers since the IPO and presented evidence to back it up. The methodology was something out of the James Bond movie. Whoever wrote the report had hired 92 full-time investigators and 1,400 part-timers, sent them to stand outside 620 Luckin stores across China, and recorded over 11,000 hours of surveillance footage to count exactly how many cups of coffee were sold per day. They collected more than 25,000 customer receipts to cross-check actual orders against what Luckin was reporting to investors. The number told a story that had nothing to do with what the company was telling Wall Street. The American short seller Muddy Waters published a report a few days later. Luckin denied everything. The stock wobbled a bit, but ultimately recovered. Of course, a lot of investors wanted to keep believing the dream wasn't dead. It took Luckin's own internal investigation 3 months later in April 2020 to confirm what the anonymous report had already laid out. The CEO had fabricated $310 million of sales out of thin air. What followed was the kind of collapse that doesn't usually happen to companies that big that fast. The stock lost 80% of its value in a single trading day, wiping out roughly $5 billion in market cap before American investors had time to finish their lunch. The Nasdaq delisted them in June, the SEC handed down a $180 million fine, and by the end of the year, Luckin was filing for bankruptcy protection. Every story like this one usually ends here. The fraud gets exposed, the founders get kicked out, the lawyers move in. Look at Enron in 2001. Look at Wirecard in 2020. Same playbook. The fraud comes out, the stock collapses, the founders go to prison or on the run, and what's left of the company gets sold for parts to whoever shows up with a checkbook. That's not what happened with Luckin. The largest shareholder at the time of the scandal was a Chinese private equity fund called Centurium Capital. Most investors in Centurium's position will have done what investors usually do in that situation, which is write down the value to zero, take the loss, and move on to the next deal. But David Lee did the opposite. He doubled down, put more money into Luckin to cover the legal fees and the SEC fine, and brought his own team to run the cleanup. The new CEO installed was a man named Guo Jinyi, an operator who had been running Luckin's operation behind the scenes since 2018. Guo had no public profile, never gave interviews to Western media, and is one of those Chinese executives most people in the global coffee industry still couldn't pick out of a lineup. That wasn't a problem for Centurium. They didn't need a face. They needed someone who understood how the machine actually worked and who hadn't been part of the fraud. Because the bet Centurion was making came down to one specific belief. The previous management had cooked the numbers, but they hadn't invented the customers. Real people were walking into Luckin stores every morning, ordering coffee through the app and coming back the next day. The infrastructure underneath the fraud was producing something real. And if you strip out the lies and rebuild the company around what was actually working, you weren't dealing with a dead business. It was just a business that had been temporarily mistaken for a dead one. 3 years later, Luckin had emerged from bankruptcy, restructured its debt, and was opening more new stores per day than any other coffee chain on the planet. By 2023, they had passed Starbucks in total revenue inside China for the first time. By 2024, they had passed them in store count by a margin so wide it stopped being a competition. The funny thing is that almost nobody outside China noticed. While Western media was still writing postmortems on the fraud, Luckin was becoming the largest coffee chain in the world. And every analyst on Wall Street missed the obvious. Luckin isn't a coffee company. The cup in your hand is just the bait. If you walk into a Starbucks anywhere in the world, the business model is one your grandfather will recognize. The company buys coffee beans, employs baristas, rents real estate, builds an atmosphere, and sells you a cup of coffee at a margin that pays for all of it. The product on the menu is the product you're buying. Luckin doesn't work that way at all. The cup of coffee you're drinking is real, but it's not how Luckin actually makes its money or where the company creates its real value. The coffee is the entry point into a system that monetizes you in ways most customers never realize. Luckin has roughly 290 million registered users in China, and the only way to order anything is through that app. Every transaction generates a stream of data. What you ordered, when, where, at what price you actually paid after the discount, what promotion convinced you, what time of day you bought, how often you came back. Multiply that by hundreds of millions of users across thousands of cities, and you've got something no traditional coffee chain have ever had access to. A real-time map of what Chinese consumers actually want, broken down by demographic, neighborhood, and time of week. This is how the famous coconut latte got built. Luckin didn't hire a celebrity barista to invent it. The algorithm noticed that female office workers between 22 and 28 in Tier 1 cities were rejecting traditional espressos-based drinks and gravitating towards sweeter, milkier, more exotic flavors. Engineers followed the data. 300 million cups later, the coconut latte alone generated more revenue than most independent coffee chains make in their entire existence. The Mao Tai Latte, launched in collaboration with the China national liquor brand in 2023, sold 100 million yuan worth of drinks on its first day. Starbucks tested new products for 6 months before launch. Luckin shipped 120 new drinks in 2024 because the algorithm tells them which ones will work before they even brewed. And that's not all. There's the franchise model. Luckin advertises a zero-fee franchise program to attract operators in Tier 3 and Tier 4 cities, the smaller markets where Starbucks never bothered to expand. It sounds generous until you look at the contract. Franchisees don't pay an entry fee, but they're required to buy everything from Luckin. The espresso machines, the beans, the milk, the syrups, the cups, the leads, the packaging, even the point-of-sale software. The model is the same one Mixue, the Chinese bubble tea giant with 53,000 stores, has been running for years. I wanted to make a video about it, but I'm not sure you will actually care. Let me know in the comments. But about Luckin, the franchisee thinks they're opening a coffee shop. They're actually becoming a customer for Luckin's supply chain, locked into a recurring revenue stream that has nothing to do with the cups of coffee they sell to walk-in customers. Of the 31,000 Luckin stores in operation today, about 8,000 are partnership stores. Those 8,000 stores are paying Luckin every month for inventory and equipment, and that revenue line is far more stable than the discount-driven margins on the coffee itself. And the icing on the cake, the last piece of the puzzle, is speed. Luckin opened 8,700 new stores in 2025 alone. That's an average of 23.8 stores per day, roughly one new opening every hour for an entire year. No traditional coffee chain on earth can move at that pace, and the only reason Luckin can is because the model isn't really a coffee chain. Each new store is a delivery point plugged into the same software supply chain and customer database. Once the system exists, scaling it is closer to launching new servers than opening new restaurants. This This is what Centurion had figured out in 2020 when nobody else would touch the company. Luckin had committed fraud, but the underlying infrastructure was a platform, not a coffee shop. And platforms, once they reach a certain scale, are very hard to kill. Starbucks was selling coffee against a competitor that has simply turned itself into something closer to Amazon with a milk steamer. There's the version of Asia you don't read about in Western media. This is the gap I see every day from the inside. That's why I built this channel, to fill the information gap. If that sounds useful to you, subscribe. Once you understand what Luckin actually built, what happened to Starbucks stops being a story about competition and becomes a story about category mismatch. Starbucks did everything you're supposed to do as a premium coffee chain. They invested in the experience, in barista training, in store design, in supply chain quality, in the slow construction of brand equity that traditional retail has spent 50 years perfecting. None of those moves were wrong on their own terms. They were just irrelevant to what was actually happening in the market. The numbers tell the story without commentary. Market share in China dropped from 42% in 2017 to 14% by 2024. Same-store sales went negative. The board fired the CEO and brought in Brian Niccol from Chipotle, paying him $85 million in cash and stock just to sign on. None of it stopped the bleeding. In November 2025, Starbucks announced it was selling 60% of its Chinese operation to Boyu Capital, a Chinese private equity firm, for around $5 billion. Officially, the deal was framed as a strategic partnership that will accelerate growth in the region. In private, every executive who has ever worked in international retail knows what that language means. Starbucks couldn't win the market, so they sold the keys to someone who might. The same month, Starbucks signed that deal. Luckin opened its 10th store in Manhattan. The pattern of the opening is too consistent to be a coincidence. Every Luckin in New York is positioned within a block or two of an existing Starbucks, and several have landed on real estate that Starbucks recently abandoned. It's a demonstration of power. Luckin is showing the American coffee industry what the next 10 years are going to look like by parking themselves in front of the symbol of the old order. In Singapore, the playbook ran ahead of New York. 3 years after entering the market, Luckin operates 68 stores across the city. In Malaysia, 45 jointly operated locations. The international footprint is still small relative to the 31,000 stores in China, but the structure is being built deliberately, market by market, in cities where the entrepreneurs and the early adopters live. In February 2026, Luckin opened its first premium flagship in Shenzhen, a 2-floor, 4,500 square foot store that sells pour-over coffees, rare beans origin from Yunnan and Ethiopia, and specialty drinks at higher price points. The format is a direct attack on Starbucks Reserve, the high-end concept Starbucks has developed precisely to defend the premium segment that Luckin's budget kiosk was supposedly leaving alone. Wait times during the launch reached 3 hours. The last nail of the coffin was hammered yesterday. Centurion Capital, the private equity fund behind Luckin, confirmed the acquisition of Blue Bottle from Nestle. The same brand that Nestle had bought in 2017 for $425 million, the brand that became the symbol of California's third wave coffee movement, is now owned by the same fund that controls the largest coffee chain in China. Luckin is now actively preparing to relist on the Nasdaq. The same Nasdaq that delisted them 5 years ago for fraud is ready to welcome them back. Beautiful story, no? Whether Luckin pulls off the next chapter is quite frankly an open question. The most recent quarter showed cracks. A sharp deceleration from the 50% revenue jumps of earlier quarters. Operating margins are eroding as more orders shift to delivery, where the unit economics are weaker. But the bigger story isn't whether Luckin specially wins or stumbles. The bigger story is that Luckin is the first of a series. Miyue, the Chinese bubble tea giant, has 53,000 stores and just IPO'd in Hong Kong with the same supply chain playbook. Anta has overtaken Nike in China. Each of these brands is running a version of the same model, and each of them is preparing to cross the same border that Luckin just crossed. If you run a business that competes with any Chinese brand in any category, what you just watched is a preview, not an exception. And if you want to know which Chinese company is coming after your industry next, that's exactly what this channel is going to keep covering. So don't miss it and hit subscribe. See you in the next video.